Morning, Julia. I think it's a radical shift in terms of central bank thinking overall for global central banks. It's something major central banks such as the ECB will have to take note of, which is Jerome Powell essentially acknowledged that COVID-19 is inflationary. And previously, the hit to demand from mobility restrictions and social restrictions had deemed COVID-19 to be demand destroying and therefore a deflationary pressure. But because of the supply chain issues and because they're not going away, you mentioned the PMIs this morning in Europe, essentially saying supply chains have gotten worse, if anything. It's a key determination of the central bank to change their view away from this transitory nature of inflation towards actually looking at COVID-19 and saying, hang on, this might leave a permanent mark on inflation. We're not going to see 5-6% inflation next year, but it could be above the Fed's 2% target. And that's something they have to react to. What does that mean for markets? Well, in the morning yesterday, you saw the dollar was quite broadly weaker, and the markets are looking to buy risk assets and also fade positioning. So long dollars is a crowded trade in the FX market amongst the macro community who are still in FX trades. And amongst those trades, euro dollar has done very well. So it makes sense to unwind that short euro dollar position given the risk off fears we have of Omicron. But it seems weird for me for euro to strengthen in an environment where the Fed is looking to accelerate tapering.
Jordan, I want to pick you up on the comment you just made about the macro community that is still in big FX trade. How is positioning at the moment?
We use a few indicators. We use futures, we use SDR data, which captures option flows. Look, essentially futures are saying that euro dollar positioning is short, so long dollars is the consensus trade, but it's not big. And because of the sell-offs we had in front-end rates, a lot of hedge funds are just not involved in the trade as they usually would be because they're down 10 to 20% on the year. And we've got less than 1 month now until year end. A lot of people are nursing those losses and trying to avoid getting caught up in whippy markets. And as you're seeing in the dollar right now, it's pretty choppy.
Similar to what we're seeing in equity markets as well, with a lot of hedge funds just wanting to lock in what gains they have made at this stage, given the volatility. Jordan, in terms of the Fed, does a faster taper necessarily mean sooner than anticipated rate hikes? The Fed chair has been keen to dissociate the rate hiking cycle from the end of bond purchases. But what should we read into the future path of rates on the back of these comments around tapering yesterday?
For economists, what you just described is probably the narrative you'll hear from all of the sell-side notes. So essentially, the Fed tapering faster does not necessarily mean they raise rates faster. For markets, that's just not how they will work. A faster taper means higher chances of an earlier rate hike. So I'm looking at the May pricing. So the meeting in May has around 18 basis points priced in before the Omicron variant came in. We're a bit shy of that right now. I think it's moving quite a lot this morning, but let's say we're around 15 basis points. So we still haven't recovered yet the Omicron sell-off from Friday. And so maybe we see a bit more priced in for the Fed on the back of Powell, and that could support the dollar. But let's just walk through the timeline. Inflation peaks in February. We get that data in March, and it's going to be really hard for inflation to keep rising from February onwards because energy prices eventually will cool down, especially as we move into spring. So the Fed will be looking to raise rates as inflation is falling. The question is, how far and how fast will it fall?